Welcome to the Standard Deviations Podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times bestselling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations Podcast. I am your host, Dr. Daniel Crosby, and I am joined today by my friend Phil Bak, who is the CIO of Signal Advisors. Phil, welcome to the show.
Thanks for being here. It's an honor.
Yeah, absolutely. So I want to start off, first of all, we got to talk a little bit about this market. We'll get into it in greater depth in a second, but we're here on Thursday, January 7th, and the U.S. Capitol was breached yesterday. The Democrats won, evened it out in the Senate here in my home state of Georgia, which was largely heralded by many Wall Street prognosticators as bad for the market. Draw your own assumptions there, but that was certainly sort of the buzz, was that it would be tough for Wall Street, and Bitcoin was buzzing right around 40,000 today. Ethereum's up 100% this year. The market is on an absolute tear. Coronavirus is worse than it's ever been. What sense do you make of this disconnect? Is it as simple as the market being forward-looking, which we know that it is, or is it more than that to you?
A little frothy, right? The market looks a little frothy, to say the least. I don't know. I mean, the answer is I don't know. There is clearly a disconnect between, fundamentals and where the markets are trading. I mean, you look at unemployment numbers that would have just a few years ago moved the market in a dramatic fashion, and now it just doesn't. And there could be several explanations. I think the TINA, there is no alternative, is certainly one where, interest rates are down at basically zero. And, where are you going to put your money if you need yield? If you have a mandate where you have to put money to work and you have a narrow list of securities that you can invest in, well, fixed income. I mean, there's really very little places where you can get any kind of return that's got any safe harbor. And I think there's also a feeling where monetary policy is going to continue along the trajectory that it's been on, which ultimately is going to lead to modern monetary theory, which, I don't want to go down that wormhole, but, ultimately there could be inflation, there could be rising asset prices. But when you look, we lost the commercial real estate sector entirely, right? Oil and gas is so low. The entire private sector and unemployment is tragic. It's a real tragedy. And the market valuations are not reflective of it at all. So it's very difficult. We've never seen anything like this before. And I could tell you how it ends no better than anyone else.
Yeah, one of the things about our job is that it does keep you humble. I think just when I've seen everything, or at least read about everything, right? At least sort of have pre-experienced things through my study of market behavior and market history, the market makes you look foolish again. So certainly with you in not being able to forecast anything. I think you and I have both been impacted by the thinking of Ben Hunt. I know I've been listening to a lot of his stuff recently, and he talks about playing the players, right? Like if you think about a poker game, a lot of folks try to play the cards, and he talks about playing the players or taking behavior into account when thinking about the way that markets move. And I've been very influenced by his thinking lately, and I think it's showing up in a big way in today's market.
Yeah, and I have as well. And, one of the things that he's talked about is the disconnect between, fundamentals and where stocks are trading, but also the disconnect between taxation and spending in the government, right? Once you say that you don't need to balance the budget indefinitely, then what is taxation but redistribution? What is government spending, right? All these things just become completely different. So, you have to some extent, you have to just say, it's not about being right, and it's not about what the market should be worth. If I'm responsible for other people's money and I'm responsible for making smart, prudent investment decisions, you have to project where the market's going, in part by where the market players are going, which is exactly that point. What is the point at which buyers and sellers are going to meet down the road versus today? It becomes very murky when you're untethered, when you can't just fall back on well, the value of a stock is, the present value of its future dividend payments. Like that's done. That is done. Nobody's doing that kind of fundamental work anymore. And I don't know if, how, or when that'll ever come back.
Yeah, it's interesting. When I was doing therapy work, I would do some marriage counseling, and it must be said that I thought I was a very good therapist. If I do say so, I thought I was a good therapist for individuals. I was a very bad marriage counselor. Like my marriage counseling record, I mean, I'm batting nearly zero with my marriage counseling. But one of the things that I would observe in couples therapy is couples kind of litigating against each other, right? So sort of fighting with each other. And I remember in exasperation saying to one couple, do you want to be right or do you want to be married, right? Like, do you want to make a case against your significant other and sort of convict them in the court of Dr. Crosby's opinion, or do you want to begin to work towards a solution? And I think that's the kind of market we're in. Do you want to be right or do you want to make money? Do you want to stick to these old cherished ideas you have, or do you want to make money? So with that in mind, when do you think it's the right time to check the math on how enduring a factor is, or something like discounted cash flows, something like fundamental analysis? How do we know when it's true fear or greed or irrationality, or when the world may have shifted so fundamentally that something we used to love and believe in, it's time to move on from that? How do you think about that?
That's such a difficult question to answer, because if you look back historically, you've got, like, let's take value. Let's distill it down to, assigning value to stocks. You're going to define their intrinsic value, and you're going to say that, you can buy it, where it's trading today tells you that it's over or underpriced, which is completely different than like a momentum or growth strategy where you're buying what's hot. Historically, there's been a pendulum, right? And every 5 to 11 years or so, you go through these cycles, and market and values in favor versus, growth or momentum or these other factors. And the forces behind that pendulum, nobody really knows. Nobody really understands. Why does it snap back? What's the impetus? What's that moment at which all of a sudden, the pendulum starts moving the other way? So what you have to do is you have to make some sort of bet that either that pendulum is, that's the ebb and flow of the markets, right? Just like the tide comes in, the tide comes out every day, right? You have to have faith in that, or you're going to say this time is different. And we've heard this time is different. Anyone who's been in the game for a long time has heard that, many times, and it never is. The market is always comes back to these forces, and you have to have some sort of faith on it. Because if you go entirely quantitatively and you study these factors, when a factor comes out of play, all of a sudden the math looks very different. If I'm running a 10-year backtest on value today versus 10 years ago, I'm going to have a completely different result. If I'm running a 50-year backtest today versus 10 years ago, I'm still going to have a very different result and a different conclusion. So you can get blown around by the math. You have to, obviously, of course, you have to, tether yourself to the math. You need some sort of, empirical, proof to do anything you're doing in the markets. But to tie yourself to that entirely is very difficult to do when you're still making a bet in some way, in some form. You're going to have a bet on either some sort of mean reversion or some sort of new paradigm that's been created. And it's a very, very difficult question to answer. I am, of the belief of mean reversion, of, lasting principles of the market, that there will be some sort of return to value. There will be a return to fundamentals, but I could not tell you why. And as they say, the market could stay irrational a lot longer than you could stay solvent.
Yeah, last year was so fascinating to me, because it was like we lived an entire lifetime of market emotions in a single year, right? I mean, just backbreaking fear and breathtaking greed within seeming minutes of each other. And it really, really thought that the virus might be the thing to sort of snap people back into more of a value-focused, fundamentals first type mindset. And that wasn't the case. You talked about some of these enduring principles. When you think about this is a common interest we share, right? Like taking a large problem, trying to distill it down to its essence. It's what I've tried to do with my books. Well, in your study of markets and in your study of behavioral finance, what do you consider just a couple of the most enduring principles of good investing?
I think, to me, at the core, at the heart of the whole thing, when I think about behavioral and I think about what that means to how I see the markets, the core of the thing is essentially that I am an idiot. And, that's my general framework. It's that I, like everyone else, I get greedy at the wrong time. I get afraid at the wrong time. My gut is telling me something, and whatever that gut is telling me or whatever it's coming from, I need to ignore it because it means absolutely nothing. So for me, when I think about the behavioral aspect, it's more about, having some sort of root in mathematics and some sort of, long-term view that there's a natural ebb and flow to the market and a natural rhythm to the market. And, don't fall victim to my own hubris, be very aware of my own limitations like everyone else. So, the behavioral framework for me is really about putting guardrails around myself to protect myself from being, as dumb as everybody else.
So, Jim O'Shaughnessy, friend of the show, of What Works on Wall Street fame, he has this great line that I'm going to totally butcher, but says, basically the first step to being a good investor is understanding that you're just as prone to bias as the next person. And I think that's such a great way to think about it is, we talked on your podcast about my TED Talk, You're Not That Great. And I think realizing that you're not that great is one of the most enduring and practical ways that whatever your particular tilt or flavor of investing, understanding that you're not that great is the common place to start. So Phil, you've been a vocal proponent of reverse weighted ETFs as opposed to the more traditional cap weighting or even equal weighting. What do you see as the advantages of reverse weighting?
So full disclosure, I own the entity that launched the reverse cap S&P ETF. And it's a strategy I came up with, but to be clear, this isn't like some brilliant complex AI modeling that we labored on. It's really the simplest thing that we just kind of stumbled into. And I think the beauty of it to me lies in its simplicity. And in essence, if you take at face value that buying by market cap, so the standard index fund strategy where you just buy securities at whatever they are trading at any time, if you say that is inefficient, and that's debatable and it's a fair debate, but I think there are plenty of people who agree that that is an inefficient way to buy. Well, if that's inefficient, then in a zero-sum world, where does that inefficiency go, right? What is the one minus that, right? How do you take that extra alpha that's being created on the other side, on the reciprocal side of that? And when you look at the reciprocal of the market cap, you take the inverse of the market cap, you end up with the same stocks that you have as, in the baseline index, the exact same stocks, but in a counter-cyclical way. So reverse looked like it was a strategy that hated financials just before the global financial crisis. Now it's a strategy that looks like it's anti-tech and certainly anti-FANG. It's always a contrarian play. And, when mean reversion comes back into the market, that's how it produces a lot of the historical outperformance that we've seen in a fund, because you're always, by definition, you're buying low and you're selling high, as opposed to a market cap weighted fund where as the stock goes up, new money coming in will buy more at the higher price than at the lower price. So there's a size factor play. So typically smaller stocks will do better than large caps. But it's really, as much as that, it's really a mean reversion play. And, in terms of size, the criticism with the size factor is that when you get to these micro caps and small cap companies, the factor scores are the market capitalizations themselves, and they blow around a lot based on thin volume. These are smaller companies that don't have as much analyst coverage and volume. Well, when you limit that small size bet within large cap, within the S&P, all of a sudden you're dealing with companies that have good liquidity, that have good quality and analyst coverage. So, we found that that's where it works best. Look, it's a simple strategy. We've launched it about 3 years ago, and it has been, since it launched, the worst 3-year period for performance in the history of S&P data, as these FANG stocks just ran nonstop from the day we launched. And, I think, that might be starting to turn, certainly in the performance it is, but the beauty of it, because it's such a simple strategy and because, we believe so strongly in the mean reversion factor, is that even through periods of underperformance, we still believe in it. I believe in it just as much today, if not more, than I did the day we launched it. So, it's a long-term strategy, and we think it's a very simple and easy way and a very good bet to provide marginal outperformance over the broad cap weighted indexes over time.
Do you worry at all that the rise of cap weighted index investing becomes a self-fulfilling prophecy, right? I mean, I think index investing came into vogue because of the important work done by Jack Bogle, and all that was a simple idea that sparked a revolution, and there was so much truth to it. And obviously, the proof has been in the pudding that index investing has been a good way to go. But do you worry that because everyone sort of knows that it becomes self-fulfilling, that cap-weighted indices just pull further and further away and continue to leave the philosophically sound reverse weighting in the dust? Do you worry about that self-fulfilling prophecy at all?
Very much. And it's not only a question of, the reverse strategy specifically, it's really a question of our capital markets. And, when you look at it, right, so in order for the market to come to a consensus on what the value or the price of any given stock is, you need to have price setters. You need to have people who are willing to say that I will buy this stock at 40, but I will not buy it at 41, right? I mean, there has to be some element of the market that's doing that. And right now you have, with the rise of index investing, not only the majority of assets coming in at passive or index investing, but when you look at the derivative markets, they're all based on the same indices. When you look at direct investing that is tied to benchmarks, and maybe they filter out some stocks, but for the most part, they're buying at market cap weighting. So, and then of course, the biggest market right now is probably the market makers and the high frequency traders who are hedging. They're all hedging between the stocks and underlying derivatives. So the question is, who is out there doing fundamental research, keeping these companies honest, reading the 10Qs and the 10Ks and, assessing risk and really doing the deep work to understand what the value of a company is and then setting the price there. And I worry very much that the market has lost that function entirely. And, what the end result or the outcome of that is, if that's the case, is beyond my ability to really assess. I don't know.
Now, this is a question about which smart people disagree vehemently, but do you have a sense, either from your research or even an opinion, about at which point sort of the rise of passive investing becomes problematic? Because I think, at some level there's not enough passive investors. There's enough active price discovery that the people who are passive investors are not moving the needle. But at some theoretical point, the problems that you talked about certainly do begin to take shape. Do you have an opinion about what that split looks like?
I have an opinion. I don't have data on it. It's a very difficult thing to quantify and to understand. And a lot of people have tried, and I don't know if anybody's really nailed it. So I don't have a data point on it, but I do have an opinion. And, to me, I think the real telltale sign here, I think Tesla right now is such a critical data point in where we are in the zeitgeist. And you look at a company that is doing, a fraction of the auto sales, right? A small fraction. I think it's about 3% in the US and even less globally. I could be wrong on that, but a small fraction of the auto sales. And they are worth right now by market cap more than the entire rest of the auto industry globally combined. And it's just an unbelievable thing. And I understand that people are, very bullish on what they're doing on the battery technology side, or the ability for them to convert their fleet into, autonomous taxis and all these different things. But, I would argue that those are very much priced in at the least at this current valuation. And I think that is really the biggest example of where a company has been untethered from its valuation. And, now it's gotten into the S&P 500, and you've got all this support now, all this money that's coming in that's buying it at its current level. And the question is, will Tesla break the mold, right? Will there be a point where the market says, you know what, Tesla is worth a fraction of what it's trading at today, and it's going to kind of break down, at least from a stock price or from a temporary stock price perspective, it's going to break down and really make the case that people need, some sort of active management or price setting mechanism in the market, some sort of tether to fundamentals. But when that point comes more broadly, I don't know.
Yeah, if you think reverse weighting the S&P has been tough, say a prayer for Tesla short sellers over the past few years, because my goodness, that has been a rough gig. Now, Phil, you've worked at the New York Stock Exchange, a number of storied fund shops, as well as having started your own ETF company. How would you describe the state of the asset management industry broadly? How do you think about that industry?
So it's interesting that you bring up the NYSE and the asset managers. The story has been very parallel in a lot of ways. And you look at the NYSE, and I think what's happening to the NYSE now really goes back to the implementation of Reg NMS, which is an SEC mandate that was put in 15 years ago. And it took the exclusive trading rights of companies that were listed on a stock exchange away from those exchanges, which means that if a company lists with NASDAQ or NYSE, you can also trade that stock on a different exchange, on the other exchange, or on one of the 30 or so other exchanges that are out there. So the exchanges themselves only trade a fractional amount of each company. And the increased competition now between all these different exchanges and other systems has driven the trading fees down to near zero. It's introduced a big risk on unintended consequences of market fragmentation and fragmented liquidity. But it's also, on the other side, it's been great for investors. We have never had a capital market system in the world as cheap, as fast, as secure, as easy to transact as we have now with the US stock markets. And you look at the asset management side, and it's very much the same thing. What started as a rallying cry around democratizing investment strategies, especially in the ETF industry, which has been called the Silicon Valley of finance, where you can come with a great idea and launch an ETF, and all of a sudden it's accessible, same way as stock is accessible. It's accessible to all these investors. But fast forward, and it's turned into a commoditized marketplace where funds are being issued, in some cases below cost, just so that companies can grab market share that can be monetized in other ways. So it's a huge win for investors. They can access all these strategies so efficiently, so cheaply. But it's also kind of the end game for the asset management industry. So, look, ultimately, at the end of the day, a fund, an exchange, right, it has to offer investors a value proposition that is in excess of its fees, right? That's ultimately what it has to do. And some do, many have failed to do. Famously, active management has typically underperformed passive. So, look, hopefully there'll be some way to get back to that. Hopefully there'll be some, winners on the active side so that, like we were just talking about, so that there's a mechanism for price setting and price discovery. But, it's really, the impetus is on the asset managers to be able to prove their worth. But, what we're seeing right now is very bad for the asset management industry, but great for investors.
So Phil, if I tasked you tomorrow with starting an actively managed fund or ETF and said, you've got 5 years to make this as successful as you can, how would you structure it? What would your strategy be? What sorts of asset management type setups do you think work in a world where fees are being eroded at such an extraordinary rate?
Ultimately, you have to have some sort of edge, right? You have to have some sort of process or some sort of insight or something that is not, otherwise available freely, right? So if I say, I think value is going to come, I think value is going to come back into fashion. Well, again, that's like we talked about with the behavioral stuff. That's my gut saying something that may happen, that may not. It's, probably a coin flip, right? If I say, well, I'm gonna bet on value and I'm gonna sort stocks by, PE ratio. Well, that's publicly available. Anybody can do that themselves. They can, my competitors can do it. You can do it, pretty much if you have any sophistication, you can do it in your personal account. So the question becomes, well, what kind of edge do I have? And I think there's a lot of opportunity for asset managers to focus on those edge. I think one of the key areas is on forensic accounting, right? If you tell me that you can specifically spot and avoid fraud, that's something I'd be very interested in. Well, I pay you a premium, and in my fund, I know that I'm going to, have a high likelihood of avoiding the next Enron, because we know the next Enron is out there, right? We just don't know where it is. So I think that's one area that is very interesting. There's a lot of alternative investment strategies that, have been very successful for hedge funds that I think have not yet been popularized. And, there's a thing in the markets where a lot of strategies have been distilled down to factors that have become very consensus, right? So you've got your value, growth, momentum. You've got other factors as well that have become kind of consensus. And as the active management space has become more and more quantitative over the last 20 years, we've lost a lot of creativity that used to be in the markets. And a lot of creative strategies now just get kind of dismissed out of hand. And, I would love to see a return to, a whole rainbow, a whole spectrum of different strategies that, some are maybe outside the box. And I'm sure a lot of them will get dismissed out of hand, right away. But so is Cathie Wood with her innovation strategy, right? So were a lot of the strategies that work now were dismissed initially. So, I think you have to think about some sort of edge, doing something a little bit differently, but also, being not only quantitative, but also creative in the process, and, be willing to explore strategies that are not yet out there.
Okay, so if anyone listens to this and starts a forensic accounting fund, you owe Phil, and you owe me as well. You owe Phil and I both a cut. So as I mentioned in my last question, you started an ETF shop, Exponential, and you recently exited that, which you've referred to as equal parts success and failure. You've talked to me a bit on the side about how tough that was for you as an entrepreneur. What are some of the lessons learned? What sense have you made from that experience? And can you talk about that bittersweet sort of success and failure?
I think if you go back to the point that I left the New York Stock Exchange to start the company, and I think there were people that knew me that were surprised when I started Exponential ETFs, at least in my mind, in the story that I made up. Because I myself was, found it barely believable that I was an asset management CEO. So certainly other people did as well. And there was some skepticism. And, as a result, I played tricks on myself to convince myself of all sorts of things, that I belonged and I deserved the opportunity. And, also on the inevitability of our success. And not only that, I think I also convinced others around me on the inevitability of our success. And as a team, at Exponential, there was no doubt that Exponential would become wildly successful. And, fast forward a couple of years, we did have some successes. We pivoted the company a couple of times, and we found a niche as an ETF sub-advisor. We had, in the end, about 14 clients, and a few of them hit it big, and we got to ride their coattails as far as that side of the business, as far as the trading and sub-advisor side of the business went. But we also failed at our core mission, which was to grow our proprietary funds. And the realization and acceptance of that was very difficult to process. It still is very difficult to process. And ultimately, you have to accept the reality around you. You have to keep moving and create new realities, but that's a process. And it's a very lonely process, because in the grand scheme of things, look, there should not be a lot of sympathy reserved for, pivoting founders. There are better places to assign that sympathy, but it's still a very lonely process, because there are very few people that have been in that spot, and not had the success that they anticipated, and are, able to talk about it and share that experience. So it's something I had to work through, and probably something I'm still working through. And, honestly, I don't know if it's something that I will ever fully get over.
Well, I certainly appreciate your candor in talking about it. I thought that paradox that you presented early on is so poignant and so telling, because you have this imposter syndrome, right? And I think it's something that I experience and everyone experiences to some degree, of you've taken on this ambitious undertaking, you're going to do this big thing, and you don't perhaps feel equal to the task. So you have to fake it till you make it. You have to act like you belong. But sort of part and parcel of that acting like you belong, or believing in the inevitability of success, if I'm hearing you right, perhaps you overlook some things, you overlook some pitfalls or some risks that were there. If you had it to do again, how would you have that positive attitude, have that can-do spirit, but not overlook those risks?
I'm not sure. I'm really not sure, because I think if we didn't have that up front, if we didn't completely blind ourselves to the possibility, to even consider the possibility that we were not going to be successful, then the successes that we did have, I don't know if they would have come. And, the successes that we did have were not the successes that we anticipated and all that. But, I don't know if we would have kept going. I think we probably would have thrown in the towel super early. And look, maybe that would have been better for everyone. I don't know, but I think that, the way we convinced ourselves that, we're going to have the ultimate success that we envisioned, the way we, completely dismissed any negativity or doubters, I think that was very necessary. And even though at the end of the day, we didn't reach that view, we didn't get there, I think we got a lot closer because we aimed our sights there. And, like I said, like at the end of the day, when our reality and the reality, right, when they meet up at the end of the day and you look back on it, it feels like a downer, feels like a disappointment. But I think you have to do that as a founder. You have to set that vision for yourself and for your teammates and for your company. You have to do that, and you have to set it high, and you keep working at it. And look, my story is certainly not done, and the people I worked with are certainly not done. And I think if we keep some of that, then it's going to serve us well. But it's also very crushing to to have to accept that at the end of the day. It's a tough thing. It's the games that we play inside our heads are so much more important than the games we play on the battlefield, right? When it comes to business. And that's something that I didn't believe when I was young, but I do believe now.
Well, I hope people will listen to and re-listen to the remarks you just made. I think there's so much psychological depth to that. Every entrepreneurial journey is on its face irrational. Like everyone who ever starts a business, anyone who ever starts a restaurant or, does anything, the odds, like mathematically, it's a bad idea. And yet we're so glad that people take risks, right? We're so glad that people open restaurants. We're so glad that people start businesses, and it's the engine of our economy. And yet every single person who does it is being overconfident in a sense. And so I think you've spoken to the trickiness of that, of walking that line, of saying, an entrepreneurial journey is in and of itself an irrational undertaking, but it's one, worth taking. So you said your story's not done. That's certainly the case. You recently joined Signal Advisors, an insurtech startup, but you've been in stealth mode somewhat. I'm still wanting to learn more about what y'all are going to be doing. So what can you tell us about this ongoing story?
All right. Well, look, Signal's built a technology platform to serve as the IMO function of annuity distribution. And we're helping advisors access the best fixed index annuities faster, cheaper, more integrated than ever before. But our ultimate goal, the bigger goal, is to help financial advisors provide the best retirement outcomes for their clients. So you're going to be seeing more from us, some big innovations that we're working on to deliver exactly that, to deliver the best retirement outcomes for financial advisors to utilize for their clients. It's a process. It takes some time, and there's some things that we're building that are going to be coming out that I'm just so excited about and just want to talk about. But we're growing exponentially on the IMO side. It's just such a fantastic product and a fantastic team right here in Detroit. So I'm so excited and blessed to be a part of it.
Okay, so anyone who's listened to this podcast knows that you are a wealth of knowledge about this industry. And so we wish you the very best in this new endeavor. I do want to talk about Detroit a little bit. You said right here in Detroit, you're a proud Detroiter. It's one of my favorite, it's one of my absolute favorite cities. And the reason is the people. The people in Detroit are some of the coolest people in the world. And one of my favorite things to do when I'm in Detroit is to go to a Tigers game, because the people you will meet at a Tigers game are like some of the coolest, most chilled out, laid back people in the world. So I remember speaking at a conference in Detroit and going to the gift shop to get a Coke, before, to try and crank myself up a little bit with my Diet Coke before I went on stage. And I saw shirts and keychains and stuff in the gift shop that said, "Say nice things about Detroit." And I love that. And I'm from Alabama, and I've experienced, I don't live there anymore, but I've experienced a lifetime of, telling people where I'm from and seeing them make jokes and make faces. And I hate it. So I want you to say nice things about Detroit. Why do you love Detroit? And what do you think the future holds for that city?
I love it, right? Say nice things about Detroit. Where else do you have a city where in that city You've got, all this stuff, not for tourists or outsiders, but for the insiders, for the people in the city to rally behind. Here you've got, say nice things about Detroit. You've got Detroit is the new black. Detroit hustles harder. Like all these great little brands that really celebrate the city. And I think, look, in this country, there is so many regional areas or so many cities that have just lost their unique flavor. We've got New Orleans, we've got San Francisco, we've got New York, we've got some great cities, but there are so many that you're just, you're in one city, same as the next. You're going to see the same stores and it's the same feel. And to me, Detroit really stands out. It stands for something, right? It stands for grit over glamour. Like there's a feeling here that, we're going through a rebirth. And there's a shared respect for people that are, down in Detroit that are in this together, and you really feel a part of something. So, to be somewhere where, the identity is so gritty and tough, and to feel like you're really a part of something, you're making an impact by building a company in Detroit. It's special. It's not just like you're building a company anywhere. You're building it in Detroit. You're helping to, revitalize this great American city. It's a really special thing. I absolutely love it down here.
Yeah. Well, you feel the way about Detroit that I feel about the American South. Wonderful areas full of great people that are somewhat unduly picked on. And so I'm excited for you to continue to do great things in Detroit. I'll hold down Atlanta, and we'll meet up to say nice things about our respective cities. So Phil, before we close out, I got to put you through the ringer here. I got to put you through the lightning round. I'm going to ask you a couple of questions. You just tell me the first thing that comes to your head. All right? All right. Better Detroiter, Eminem or Francis Ford Coppola?
Gonna go with Marshall. Gonna go with Eminem.
You're gonna go against the guy with Ford as his middle name.
Yeah.
That's bold. But we're here for the boldness. I love it. What were your feelings on losing the 2006 World Series to the greatest team on earth, the St. Louis Cardinals?
Well, I was at one of those games, and I remember clutching a hot chocolate to stay warm. We had gloves and a hat and boots. So the whole result obviously should be annulled because you can't play baseball in the snow. You can't play baseball in 25-degree weather. So we don't accept the results of that World Series.
The thing I remember the most about that World Series was how many errors the Tigers pitchers made. Like that was a fantastic Tigers team. And I just feel like their pitcher, like the Cardinals would hit a dribbler back to the mound and the Tigers would throw it into the stands or something. So we got very lucky there with some bad fielding pitchers, but a great team and a great legacy. An ETF that will never get made, that should get made.
It will never get made, but should get made. We'll go with the baseball card ETF sponsored by Beckett Baseball Card Monthly, because that is the training ground for probably half the people I know in finance.
I'm among them. I recently got my son. I have a 7-year-old son who I have just in the last year or so gotten wild about baseball cards, and it is so much fun. And looking at that Beckett price guide over Christmas, I was 10 years old again. And back in the junk wax era of collecting my crappy baseball cards that they were printing a zillion copies of. So it's a better time to be a baseball card collector now, I think.
Absolutely. I read something that a bunch of the Ken Griffey rookies were actually counterfeited, which, now looking back, it's like, oh yeah, obviously, right? All they got to do is print some cardboard and they could sell them for $30 each. But it was pretty shocking.
Yeah, I was telling my son about the glories of error cards. I had I was super into error cards when I was a kid, and I thought that was the coolest. The misprints and the errors were like my favorite thing. So it's funny. I got so super nostalgic looking through my baseball cards the other day because I had kept all of these rookies, the rated rookies and the future stars and things like this, of people who never, went on to have totally inglorious careers. So I went down this like deep winding meditation about love and loss that my wife thought was very dumb. So based on my rated rookie experience. Last one. This is supposed to be a lightning round, and here I'm waxing poetic. The biggest story in financial services that no one is talking about.
Liquidity. I would say liquidity is a mirage. You've got high frequency trading firms that are providing tons of real-time liquidity through arbitrage mechanisms, but That's different than actually standing in there making markets even in times of crisis in the traditional sense, where you're willing to keep assets unhedged on your books if you need to at a given price. That's not being done. And I think it's a huge market risk that is untested.
Wow. Incredible. No one is talking about that. I can confirm. So Phil, you are an incredible resource, man. If people want to learn more, where could they find you? Where can they find your firm?
Signaladvisors.com. I'm pretty active on LinkedIn and Twitter. So Twitter is Phil Bak1, B-A-K is Bak. And catch me there.
All right. Thanks so much, Phil.
Thank you.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.